सेव किया था ना?
मैं सिर्फ इसलिए गया था क्योंकि उसने मुझे कॉल किया, that's it. But listen तो.
Save it for someone else.
जिंदगी में सेव करना जरूरी है, मगर जब बात पैसों की हो, सिर्फ सेविंग से काम नहीं चलेगा। इक्विटी म्यूचुअल फंड्स में इन्वेस्ट कीजिए और अपने सेविंग्स को आगे बढ़ने का मौका दीजिए।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
You've been watching Finance Minister Nirmala Sitharaman in Washington. She's speaking out at what is called the fund bank meetings, because this is the spring season of IMF, International Monetary Fund, and World Bank. This is when they have their big meetings, and economic leaders, ministers, finance ministers from the world gather. Now, this is also when they release their outlooks. So IMF just released its World Economic Outlook, and just a week back, World Bank had also released their data. Now, this is the springtime outlook, the April outlook. IMF releases 4 of these through the year. So this is the second quarter of this year. This outlook is now telling us that India's economic growth estimation is downgraded. It's downgraded not by too much, but from 6.1% to 5.9%, something that in the world of banking and finance would be called 20 basis points. What's important is it comes on top of the World Bank projection, which again brings down India's growth projection. Again, not by too much, from 6.6% to 6.3%. Once again, you might call it 30 basis points. Now, for a large GDP like India, it's a lot of money, it's a lot of value. The fact also is that both of these run contrary to what the Reserve Bank of India has done. Reserve Bank of India actually stays quite optimistic. Reserve Bank of India latest is 6.5%, which is up from 6.4%. That is up 10 basis points. So RBI is upping it a wee bit. IMF is reducing it. World Bank is reducing it. OECD is giving exactly the same projection as the IMF now, which is 5.9%. And then there are other brokerages or other analysts who are actually taking a more pessimistic view. For example, Nomura is now saying 5.3%. ADB on the more reassuring side is closer to the RBI, that is 6.4%, Asian Development Bank. So you can see this, if you look at all this, generally you can say, first of all, that the bias generally is downwards, right? And these are very early days in this financial year, because right now, nobody quite knows how the year is going to play out. So everybody is making projections based on what they can foresee. But as the year rolls out, we don't know what will happen. At the same time, it's important that the bias generally is downwards. So what happens is, wherever the bias is in these cases, that is where the momentum usually does pick up. Usually, but not always, right? So that disclaimer is very, very important. Usually is not always. So India can also buck this, but at the moment, it looks like that the general expectation among analysts and among the global institution is that Indian economy will not grow as fast as might have been imagined earlier. In any case, it will be considerably slower than it was last year, which was 6.8%. But remember, there was also the base effect, and base effect then continues. It takes time wearing off. Base effect means if in a particular year, in the corresponding quarter or corresponding year, it was a certain amount, next year's data or next year's performance will be relative to that. So base effect is now wearing off. Base effect of the pandemic, when everything had gone down. So after the pandemic, as we know, in 2021, everything looked like boom, it had gone up. That impact continued in 2022 also. Now that's wearing off, and India is coming to a more realistic growth scenario. Having said that, the important thing is that even at the scaled down values, even if 5.9% became 5.7% or even 5.6%, the fact is that India will still remain the fastest growing major economy in the world this year. If you want to look at China in comparison, for China, the general outlook from IMF is that it was 3.0% last year. It will go to 5.2% because China has opened up. China had a continuing COVID shutdown, China's opened up, so it'll go to 5.2%. And next year, China is projected at 4.5%. So if you look at India, it's 6.8% last year, 5.9% this year, but it picks up to 6.3% next year, which, if you're an Indian partisan, which I am, looks good. That after this little trough you are correcting, and this time you are actually improving your growth rates with no benefit of any base effect, right? So Indian economy overall, you would say, is in a robust state, but the era of 7, 8, 9, 10% growth rates is now over because India has reached a certain level. That is the sobering thing. Now, what is it that's slowing down this economic growth rate even among emerging markets? So if you look at emerging markets, if you look at the Brics countries, for example, Brics is in fashion these days. So I pick up this economic data and analysis, at least some of it, also from the analysis put out by Bank of Baroda. Bank of Baroda's economic analysis team led by Madan Sabnavis, who I think the world of. Now that tells you that if you look at the Brics countries over these 3 years, Brazil 2.9% last year, 0.9, 1.5 next year. Russia minus 2.1, they are fighting a war. This year 0.7. Russia supporters say, all right, this year Russia is going to do better than Britain and Germany, which is true because Britain and Germany will see some kind of a recession this year. Britain will grow by 0.3%, if at all, according to the same IMF projection. Germany by 0.1%. So Russia gets to 0.7%. Next year, 1.3%. India, I told you, 6.8 last year, 5.9 now, 6.3 next year. China, 3.0 last year, 5.2 this year, and 4.5 next year. And again, South Africa doesn't count for that much, but 2.0 last year, 0.1 this year, 1.8 next year. If you look at these emerging markets, and this is the picture across emerging markets, or what is called as EMDEs, that is emerging markets and developing economies. The important thing is that the same IMF projection, the same IMF report, or same IMF World Economic Outlook for April has also downgraded global growth projections. So global growth projections have gone down from 3.4% to 2.8%. So global economies actually will grow much slower than they were doing earlier, or they were expected to do earlier. So that's a 60 basis points fall. And to that, everything else is connected, because underlying that, the larger decline in global GDP growth is also the advanced economies decline. Advanced economies will see quite a large fall in growth rates, which can be devastating for emerging markets. So advanced economies, last year they grew by 2.77%. This year their growth rate is more than halved. That is 1.3%. And that affects all emerging markets, including India. China is an exception this year because China was closed. China has just opened up. And how badly advanced economies are doing, I just told you that in this year, UK will just grow by 0.3%, if at all, Germany by 0.1%. So both these countries continue to be in recession. Again, if you look at the euro area, generally, euro area last year, that is in 22, had grown by 2.5%. This year, they'll be down to 0.8%. So it is the decline in advanced economies which is casting a shadow everywhere. US, I know you're curious about the US. US last year grew at 2.1%. This year is expected to grow at 1.6%. And next year, less than that, maybe 1%. And that will be a tough thing for Joe Biden because that will be his election year. In fact, among the rich economies, the only one that seems to be holding its own, and I know that in India, we get used to seeing 6% growth as not very good growth because we want 7, 8% or 9 or 10% like that. But Japan, which grows at a very low rate, if at all. In fact, for a long time, the Japanese have been desperately fighting to get some inflation. That's a peculiar kind of economy. I'm not going there right now, but the Japanese last year grew by 1.1%. They'll grow by 1.3% this year and expected to grow by 1% next year. That is a very powerful economy. For the Japanese to grow this year compared to last year is an exception among advanced economies. In fact, if they were doing a little bit better, chances are everybody would be doing a little bit better, but still they are sort of holding together the advanced economies basket. Now, the way things are going, suppose the global inflation goes up. Suppose interest rates also going up, because central banks will then attack inflation by raising rates, because politicians don't like inflation. If inflation goes up, politicians can lose elections in any country, not just in emerging markets or poor countries, but in any country. The big problem in America right now is inflation. And in a minute, I will tell you about relative inflation rates. And there will be some surprises there. So if inflation continues, if global central banks continue to raise rates, if debt aversion continues, borrowing aversion also continues, that is entrepreneurs don't borrow, and maybe the war gets worse in Ukraine, because that is one uncertainty that hangs over global markets and global economies. If all of that happens, it is possible, a lot of analysts say, that global growth may go below 2%. That, if it happens, has happened only 5 times since 1970. If that happens, that will be very bad for the rest of the world as well, not just for advanced economies. And there, one big risk factor would be the health of global banks. We saw what happened with SVB, and we also saw what happened with Credit Suisse. Now governments have moved in to rescue them. But God forbid, if this contagion spreads, then what will happen? Once again, right now the projection, the IMF projection is that global inflation will come down. It will come down from 8.7% to 7%. Again, if you look at various key countries or developing countries and advanced countries, in India, last year inflation was 6.7%. This year, it's expected by IMF to come down to 4.9%, which is good, because that means it's getting at least closer to the RBI's comfort band of 4%. RBI's comfort range is 4% plus minus 2, so 4.9 is pretty much bang in the middle of their comfort range. And if inflation does end up there in this year, as IMF predicts or IMF projects, then chances are that RBI may be less inclined or maybe less under pressure to raise rates this year, which will be good for everybody, particularly borrowers of home loans, borrowers of vehicle loans, and also buyers of government bonds, etc., which means it will be very good for the bank's health if RBI does not raise rates. But we have to see what happens with inflation, because there are uncertainties. The big uncertainty in India about inflation right now is the monsoon. IMD has said that they expect a normal monsoon. A private forecaster has said El Nino effect will play out and we'll have a poor monsoon. We don't know. And we know that agriculture is not really such a big part of India's GDP, but the fact is it makes an impact, and we have to see that uncertainty. And once again, we have to look at the health of banks and also what's happening globally. But 6.7% to 4.9% inflation is good for India. And again, the IMF projection is that next year it goes to 4.4%. Again, if that happens, you might even have a situation, and I'm not making any predictions. I don't know anything in this area. I'm just making a reasonable projection if these figures turn out right. If these IMF figures turn out right, and next year we are heading towards a 4.4% inflation, you might even see, it is not very probable, but it's not impossible to see the RBI actually reversing the cycle and reducing rates a little to drive up growth a little bit, growth and investment. Because on the investment side, India has a problem which is quite serious, and I will come to that in a minute. Again, if you look at China, inflation last year 1.9%, this year 2.0%, next year 2.2%, very stable and very low. Look at the US on the other hand. Talk about inflation. When you say inflation, usually you think of poorer countries, emerging markets, or when you say hyperinflation, then you think of banana republics, Latin American nations, countries like that. But look at America, the largest economy in the world. America last year had an inflation rate of 8%. Now you know why the US Fed has been attacking those interest rates so relentlessly. 8%. This year, IMF thinks it will come to 4.5%, which is also high. Even 4.5% inflation in the US is bad for global economies. 8% was crippling for global economies. 4.5% is bad. And they expect that next year, the following year, 2024-25, as we calculate, it will come to 2.3%, which will be sort of closer to comfort levels, although the Americans might be hoping that it goes even lower than that because they've really suffered from high inflation just as the Europeans have done. So look at the Europe figures. In the Eurozone, last year's inflation was 7.3%. In the UK, it was 9.1%. Right? 9.1% inflation in any country will make people very angry. Again, you see IMF sees improvements in the coming years. But once again, you have to think about why did these countries have this hyperinflation? Hyperinflation by their standards. All right, hyperinflation for smaller economies or Latin American economies or a Turkey or a Pakistan. You might say hyperinflation is 29%, 30%, 40%, 70%, 200%, 500%. If you decide to go to Zimbabwe and Venezuela. But for advanced economies, 8%, 7%, 9% is hyperinflation because the size of the economy is so big. Why did it happen? Why did the US have 8% last year, Eurozone had 7.3%, and UK 9.1%? That's because during the pandemic, these countries printed money because these countries thought that the people are in trouble, right? So just print money and distribute it. In America, they even sent out checks to people. In many other countries, in many other economies, they either sent out checks to people because people were at home and did not have work, or some equivalent of sending out checks to people by way of creating employment, etc. That flooded the market with money and that led to inflation. So it is the richest countries which had the ability to at that point ameliorate the people's pain. They are the ones whose people are now suffering the highest pain from inflation. The poorer countries or the emerging market countries actually did better. The Chinese did not do it, and definitely India did not do it, despite many pressures and many recommendations, both from the side of the traditional economists, but also on the part of the opposition parties and the left opinion leaders. Now, if you look at the picture only for India, so what is it that's looking good? What is it that's looking not so good? So I picked this wisdom from the Bank of Baroda analysis, that is Madan Sabnafis's team's analysis. So on the upside, number one, Indian fiscal situation is comfortable. So Modi government, the finance minister has managed the fisc well. Fisc would have gone out of whack if this government also, if Modi government also had succumbed to the pressure of printing currency, printing notes and sending it out to the poor. They did not do it. So the fisc right now seems to be in a robust state. It could be, anything could be better. The fisc could always be better. But right now it looks comfortable. Second, current account deficit is actually improving. At one point last year, it had looked like it was going out of control. It looked like it was breaching the 3% mark and then growing higher. But now it's coming under control because imports have come down and also because services exports have gone up. So current account deficit is now moderating. It has come down, may reach 2%, which is a comfortable level in fairly near future. On the negative side, on the risk side, again, the BOB analysis tells you that one is agriculture that we mentioned to you because nobody knows what will happen with monsoon. The global agricultural situation also is affected by the war in Ukraine because last year, you remember, the wheat prices, sunflower oil prices, soybean prices, etc. had gone up. Agricultural commodities had gone up because exports from Ukraine, the largest exporter of wheat to the world, that had stopped for quite some time. Now, that deal was brokered by Turkey between the UN, Russia and Ukraine. And the expectation is that deal will hold this year. But if the deal doesn't hold, then the global agricultural crisis will once again cast a shadow on India as well. Indian agriculture, we have to watch the monsoon. And second is just a speculation that suppose inflation surprises by not going down but going up. But once again, lots of things will have to go wrong for that to happen. Crude prices will have to shoot up to some unrealistic levels, or they will have to be in agricultural commodities prices. Given this situation, the IMF division chief in India, Daniel Lay, said that, look, we are coming from 6.8% last year for India in 2022. And even now, India remains a bright spot in global economies, right? That is an exact quote, bright spot in global economies. Auguste Tano Kouame, who's the World Bank country director for India, says that India is showing strong resilience to external shocks. Services exports are going up. and current account deficit is narrowing. So these are the good news stories for India. I told you about all the risk factors. And then I had mentioned to you, there is one thing about India and all the data we have, which is particularly worrying. And this is something that India and Modi government need to worry about. And they have to also analyze why this has happened. And that is private investment in India. Private investment in India has been declining since 2013. So if you see this graphic, which my colleague and economics editor Sharad Raghavan, TCA Sharad Raghavan has put together, if you see this graphic, it tells you very interestingly the point, the intersection point. See the intersection point, that is when private investments start exceeding public investments. Because governments in any case are always short of money. In between 86 and 88, you could say precisely 87, 88, but it's begun to happen. You can say between 86 and 88, the lines have intersected, which means the private sector investment line has gone above. It's cut across the public investment line, and from then it has gone up. And then comes the economic reform of 1991. So it keeps going higher and higher. Then also comes the burst of economic reform in Vajpayee's second half, that is Vajpayee's 3 years between 2001 and 2004. And private investment has kept going up. And then UPA has continued on with that reform. And once again, the private investment keeps going up. It keeps going up until it reaches the peak. So the peak it reaches actually is in 2007-8, when it becomes 27.5% of GDP. That means more than 1/4 of the GDP is coming from private sector. That's very robust. If you see the next 5-6 years, it remains in the same ballpark. Until 12-13, it goes down a little bit, then goes up a little bit. But 12-13 also, it's about 26% of GDP. So in these years, 2007-8 and 2012-13, private investment stays in the 27 to 27.5% ballpark. And then it begins to decline. It begins to decline quite steeply. So the data we have is until 2020-21, and this is data, all this data has been taken from Government of India's economic survey. 2020-21, it has declined to 19.6%, and we don't have the data yet, at least we don't have it 21-22, but from what we understand from analysts, it might have declined even further. So while at this point the government is spending money, but it's not as if public investments, that graph has really gone up. That graph is more or less stable. But this decline in private investment is a matter of concern. And that might be one reason why India's economic growth is not able to break out of that 6% trap at this point of time. In fact, may even struggle to get there in this year if IMF is right.